Asian markets were mostly lower today, cautiously trading ahead of the release of the FOMC minutes. One Fed official indicated that policymakers may still need to see an additional few months of positive data before being in a position to consider rate cuts. Over in Japan, it was reported that its trade deficit rose last month as rising costs for imports outpaced an 8% rise in exports from the year before, coming in worse than analysts' expectations. The Nikkei share index ended the day down 0.85%. In Hong Kong, the Hang Seng index closed down 0.13%, while the Shanghai Composite Index rose by 0.02%. Well, over in the United States, markets ended the session in a very positive territory, with both the S&P 500 and the Nasdaq striking all-time highs. While these moves were positive, market players are keenly awaiting to get more detail from the Federal Open Market Committee, the FOMC, minutes out later today on the detailed considerations that are being made around interest rate cuts and their possible timing. The Dow Jones Industrial Average ended up 1.7%. The S&P 500 rose by 0.25%, while the Nasdaq Composite gained 0.22%. The JSE is trading mostly in the green today, with the all-share index climbing 1/3%. Industrials are also up 1/3%, and financials are advancing by about 0.5%. The rand is trading at 18.22 against the US dollar, 23.16 against the British pound, and 19.73 versus the euro. A quick look at the commodities. Gold is trading at $2,413 an ounce, platinum at $1,062 an ounce, and Brent crude oil is trading at around $82.48 a barrel. Well, for more on the markets, I'm joined by Chantel Marks. She's the head of research at F&B Wealth and Investments. Thanks very much, Chantel, for joining us. So one wonders why market players can't just wait until they hear from key central banks rather than speculating. But of course, the FOMC minutes are out later today. So what's happening in the meantime?
Yes, so I think the big issue is that some of these Fed speakers that we've seen over the last few days have been quite hawkish, meaning that they have been, they've not really been saying anything around the timing of interest rate cuts. So I think that the market is looking forward to the FOMC minutes to see what the conclusions were around the possible timing of interest rate cuts in the US. So far, in terms of what we've heard from the speakers, it's not on the cards near term, so that higher for longer narrative still sticking with us. But hopefully we get some good news in the minutes later today.
So here at home, we've heard that the CPI print has slowed marginally relative to what we saw in March. It's up by 5.2% in April. It's slowly edging down to the midpoint. But what's your feeling around what the Reserve Bank will do in terms of policy come next week?
Yes, so we think the Reserve Bank will probably not cut rates yet. I think that they will also probably keep rates higher for longer. That 5.2% is still a little way out from the 4.5% kind of midpoint of the inflation target range that has now become the target, rather than it being between the 3% and the 6% level. We also think that the South African Reserve Bank probably has less powder dry relative to other emerging markets. So we don't think that they'll cut as quickly as the rest of the emerging markets complex. And of course, with the Fed probably keeping rates higher for longer, it's very important for us to continue to look attractive to foreign investors. And to do that, we probably need interest rates to stay at these levels for a while. Still.
Yeah. So locally, it's still earnings season. Pick n Pay released their sales update and a trading update. They indicate that they see sales up about 5.4% for the year ended February this year. How do you see Pick n Pay? We know that they haven't really been getting good news headlines. They've been compared to ShopRite, which seems to be doing much better. So what do you think of their trading update and them as a counter?
So I think from a sales perspective, it's encouraging that they maintained momentum in the last 5 weeks that we obviously didn't know before we received the sales update. They previously released the sales update for the first 47 weeks of the financial year. So that is quite positive. The loss that they're expected to record is much bigger than what the market anticipated. But my sense is that they are kitchen sinking it, meaning they're throwing everything out but the kitchen sink. So they are taking a lot of substantial write-downs to some of the businesses that aren't performing well. What I do like is the fact that they have been quite clear in what they're planning to do to get their balance sheet in better order so that they can reposition themselves for growth. They are getting rid of some of the loss-making businesses within their corporate store portfolio. So I do think that there's still a lot to be positive about, especially given where the share price is trading currently.
So in a word, is it a sell, hold or a buy?
I would probably rate it as a hold right now. We've seen a nice rally more recently. It would be a high risk buy, I think, if you are looking to enter the stock.
Right. And then hospitality player Southern Sun, they released their annual results for the year ended March. They're reporting revenue up 19% and adjusted headline earnings per share up a whopping 88%. I guess this really represents a massive improvement in the hospitality sector, you know, following what happened with COVID, etc. Your thoughts?
Yes, so a really nice recovery from Southern Sun, continuing from COVID-19 recovery that we saw in the previous couple of reporting periods as well. And we are still not at room levels or room occupancy levels that we were prior to COVID-19. What has really helped them is that during the COVID period, they took a lot of inefficiencies and costs out of that business because they had to maintain cash because they weren't earning much of an income. So that has resulted in really nice operating leverage, meaning that when they are increasing their revenue, selling more rooms, increasing the prices of rooms, you do see that filter through really nicely to the bottom line. Cash generation has also been strong, so they've managed to pay down quite a bit of debt. And of course, they're paying less interest because they've got less debt, and that supported profitability further.
Awesome. Chantel, thank you so much for your time and insights there. Chantel Marks, she's the head of research at F&B Wealth and Investments.